it looks like AI is being captured by a tiny club of trillion-dollar companies. But if you zoom in on the numbers and what people are actually building, from cyberdecks to off-the-shelf LLMs, you see a different story. A split between giant closed AI empires and a growing world of private user-controlled models. 10 years ago, AI was mostly in the background for VCs, recommendation engines, fraud filters, basic chatbots. Serious money chased social apps and SaaS. By Q1 2026, it had changed completely. In just 3 months, investors put $300 billion into around 6,000 startups, and roughly 80% went into AI. Some notable ones are XAI raised $20 billion, Anthropic raised $30 billion, OpenAI raised $122 billion this week, pushing its valuation to $852 billion. Surprisingly, $110 billion of this came from Amazon, Nvidia, and SoftBank only. However, when you read the term sheet, you realize a lot of this isn't cash, but compute credits, or what investors call committed capital. So instead of wiring tens of billions of dollars, companies like Amazon and Nvidia promise server time, OpenAI spends those credits to train models, Amazon sells access to those models through its cloud, and the revenue goes back into buying more Nvidia chips. Economically, that's a closed loop. Capital is cycling inside a small set of firms, and the true independent cash exposure is smaller than the headline valuation suggests. On top of that, the legal and accounting layers matter. A big chunk of Amazon's reported $50 billion commitment to OpenAI is tied to an AGI clause, a trigger that lets Amazon reset the deal if OpenAI crosses some defined threshold of AGI, like doing most economically valuable work better than humans. In other words, these contracts treat advanced AI as a potential restructuring of labor, and they directly bake it into the funding. Also, let's look at revenue. OpenAI is reportedly at $2 billion per month, roughly $24 billion a year, and its biggest competitor, Anthropic's at $19 billion in annual recurring revenue. But Anthropic is said to lean on something closer to GMV, the full amount customers pay before Amazon's cloud cut, while OpenAI reports something closer to the net it keeps after Azure. So the apparent revenue gap is likely larger than it looks if you just compare top line. All this capital is pushing AI into two very different architectures. Top-down, which is enterprise super apps, OpenAI and others are pivoting hard into secured integrated enterprise stacks. Roughly 40% of OpenAI's revenue comes from big corporate deployments that shows up as shutting down consumer experiments like Sora, building walled gardens for Fortune 500, using things like Model Context Protocol or MCPs for models to read only corporate data through read-only pipes, which is highly controlled and very compliant. And then it's the bottom-up local private AI model that I run directly on laptops without constant cloud access. Open-weight models can be downloaded on your hardware, agents like Hollow3 can control your computer, and orchestration tools like Agent Field and Maestri can run multiple agents into a full workflow. Even Vitalik Buterin published his thoughts today on how to get powerful models while keeping sensitive data under your control. Cyberdecks and private LLMs could very well be our answer.